wow, what happened between April and May? As the numbers are in, we are definitely in a recovery. Hi, everyone. This is Christine Kopr, Senior VP of Sales with Sotheby's Realty in Vancouver, BC, bringing you your June 2023 market update. As we thought, looking back at our numbers, as you know, we always like to look at months of inventory because it's a very good predictor of where the market is heading. We saw that the market was tightening up and increased prices were on their way, and they have definitely been locked in. Let's take a look at the stats and answer any questions you might have about today's market. For those of you that follow me, you know that we follow months of inventory very closely. 4 to 6 months of inventory is considered a balanced market. 6 months and above of inventory is considered a buyer's market, where there's way too much inventory for the amount of demand that's in the current marketplace. 4 months and below of inventory is considered a seller's market. There's just not enough inventory to satiate the needs of buyers in those current market conditions. And here we are, the numbers are in. So we missed doing April's video market update. So we're going to touch on both April and May in this video to give you an idea of where things are at as of June. And of course, this video is coming out right after we had another Bank of Canada interest rate increase. So things are going to get interesting here. But what have we learned so far? Well, April and May were spectacular months. May itself clocked in at 3,411 sales. That is fantastic. We are only 1% below the 10-year average in sales. Just to put that into perspective, month over month, it was up 24% in sales and up 16% year over year. So May was a rock star month. This also shows a vote of confidence in the recovery that we're having in our marketplace. But who knew we would be experiencing this kind of a recovery considering where interest rates are sitting today? New listings are the new inventory that's coming on the market. Of course, we want to see what's coming on, see how much more inventory is going to be available for the current demand, which is what the sales represent. So in May, we came in at 5,661 new listings. That's up 31% month over month, but still down 12% year over year. Our listing inventory, which also comes from new supply, has been in very tight territory. The new listings for May were at 5,661, are just under 4% under the 10-year average. Again, nothing crazy happened in April as well, and some strong sales there as well. Taking a look at May and April, our new listing inventory has inched up a little bit, but rightly so. And we've definitely had the demand to be able to deal with it. So we're sitting at 9,293 homes active and available on the market to purchase as of June 1st. So month over month, we're up 6% in inventory, but year over year, we're down 11% in terms of inventory. This is our total inventory available for the Real Estate Board of Greater Vancouver for all time. So this stats collection started in 2005. You can see here, this was the GFC, the global financial recession here, and you can see the amount of inventory that came on the market and very clearly, helped depress prices. But you can see ever since 2015, the Real Estate Board of Greater Vancouver and Metro Vancouver has had consistently relatively low inventory, which really does keep a cap on prices. We had a little blip up here. You know what? It's amazing that 2019, when the stress test was first introduced and a foreign buyer tax, and then, now we've got a foreign buyer ban, but clearly those are not impacting our prices at all whatsoever. So you can see that we're sitting in a very, very low inventory environment historically, and that is what is supporting our prices, coupled with buyer confidence. You can see these sales. This is over the last 3 years. Here's, the beginning of COVID, and after that, things just went wild. In terms of sales, 2021 really knocked it out of the park. 2022, while that locked in the peak values, the sales weren't quite there. However, the peak values were there, and we definitely had rock star sales back in 2022. And while the last, half of 2022 and January of 2023 were quite dismal, the sentiment was very negative. Prices were coming down. partly because, well, the buyers weren't showing up. So sales were very low, as you can see reflected in the graph. But since then, we've had this incredible rebound for several reasons, which we'll get into. But heading back into the stats, all of this always comes back to months of inventory, and it's right here. As we discussed, as I predicted, the way things were going, the inventory was starting to tighten up in comparison to the demand, and you can see that the benchmark price has been increasing as a result. So today we're sitting at a benchmark of 1.188. We're up 1% month over month. We've had some stellar appreciation each month ever since the beginning of this year. And we're only down 6% from the benchmark of last year, which was peak pricing. This is a very interesting result after having such high interest rate increases over 2022. I mean, we had so many interest rate increases, and you can even see here in January, we had a 0.5 point, was one of the last rate increases. And it was the end of January when the Bank of Canada came out and said they were thinking about holding moving forward. And it was about that time, I think we had a whole capitulation of folks, starting to get accustomed to and knowing that interest rates or higher interest rates were here to stay, and figuring out whether they could afford it or not. And once there was some kind of a end in sight, buyers had more confidence. And this is what's happened. We've had more confidence come into the marketplace. Presumably, I know there's a lot of people thinking that interest rates were going to come down next year. Obviously, with the recent rate announcement just last week with another 0.25 point increase, that's not the case. And in fact, we're probably going to see another 1 or 2 increases to really get that inflation under control. While the housing market doesn't impact the Bank of Canada's decisions around the rates, it does have an impact on inflation, and inflation is the Bank of Canada's mandate. And unfortunately, once we had a report of increasing inflation, because just about a month ago or so, you could see that the interest rate increases were taking an effect and taking inflation down from 8% down into the mid 4s. And that was a real success story for Bank of Canada, and which then meant they could hold those interest rates, give them more time to work through in the marketplace, potentially, make it harder for people to spend money, which causes inflation, as well as less spending in the economy via businesses, and or finally leading towards layoffs. The recession or the job losses haven't really come in the way that we would have expected them to. However, we are starting to see some unemployment numbers coming through, a lot of them or most of them being around in the tech sector. While we're saying all of that, I'm predicting that we'll probably see another 1 or 2 rate increases. And part of that has to do with the fact that the US Fed has been consistently increasing their interest rates. And what happens is when the Fed in the US raises their interest rate, well, money flows to the US dollar as the reserve and safe currency. And then the dollar then rises because you're going to get a better return putting your money into the US dollar. The challenge that we have as an export nation, when the US dollar increases, it makes everything so much more expensive for us in our Canadian dollars, which then therefore causes inflation. So you're kind of damned if you do and damned if you don't. In fact, the fact that the US Fed did increase their interest rates is probably a little bit partly why our inflation increased, in addition to the fact that our housing market has had quite a comeback. So it's probably going to take a couple more, shots at it to slow things down here and maybe check the reality of the situation. And let's face it, it feels like interest rates are going to be around higher for a little bit longer than maybe most people expected, but eventually they should come back down into their norms. It's a worldwide phenomenon. Most countries are experiencing this. And anyways, eventually we're going to come through the storm, and you just need to plan accordingly. One of the things I wanted to show here, though, is while interest rates have been increasing, there has been an impact on the market. And while it's a strong market, again, we are still down in some aspects. On the benchmark, it's about -6% from last year, but we're definitely catching up. And we're going to take a look and break down into each asset category. But if you're finally at the point where you want to get into a home and you can afford it, be prepared. There could be some further rate hikes ahead, but potentially some stability after that, because you can see that what the Bank of Canada did make an impact, and we're just seeing a little bit more stubborn inflation. But taking it from inflation from 8% to, you know, the mid 4% is actually quite successful. And looking back over time, real estate is not something that you trade. And, you know, it's your home. Presumably, you're going to be in it for the longer term. And you can see the performance over time. It is actually a hedge against inflation. When there's cheap money floating around, prices go up. And it's one of the few ways that people can protect themselves. And I think it's an excellent place to be invested, even if rates are where they are today. Eventually, you can get into a property at prices that are lower than they were a year ago, and then eventually refinance into a lower rate environment. But just to give you an idea of the gap here, we're going to break it down into the market segments. So detached versus attached, and condos, attached being townhomes, and then condos. In terms of May numbers, and this again is for the Real Estate Board of Greater Vancouver, 1,043 sales. That's up almost 30% month over month and 31% year over year, with a benchmark price of 1.953 for a detached home in Metro Vancouver, off the peak of 2.1. So we're up 1.8% month over month, and now we're just down 6.7 year over year. But really, prices have accelerated and it appreciated about 6% since the beginning of this year. So you can see market timing is very difficult. However, there's still some room here in terms of getting into the market or being in the market at a relatively, like a discount to last year. But also, if you're thinking about selling, the market conditions are quite strong. Townhomes clocked in at 608 sales, up 22% month over month and up 17% year over year, with a benchmark price of $1,083,000, off from the peak of 1.150. However, we're increasing 0.2% month over month, and we're only off by just under 5% year over year. So you can see, again, Vancouver is proving itself as a very resilient real estate market. And coming down to the condos, we had 1,730 sales, up 22% month over month, up 8% year over year in terms of sales, and a benchmark price of $760,000, which is up 1.1% month over month and only down 2% year over year. So there's definitely some stability there in those condo prices. There's lots happening into our marketplace, and it is amazing how fast it has changed. From December, January to a couple months ago till today, we can tell you that the beginning of May, the market activity was just strong. 20, 30, 40 groups coming through open houses, multiple offers, all of that kind of stuff. Starting to taper off as we're heading into the summer season. And of course, now just last week, our first interest rate increase since January. I'm Christine Kopr with Sotheby's Realty in Vancouver, BC. I would love to connect with you and answer any questions you have about today's real estate market, or if you're thinking about buying or selling in today's market, how we can help you achieve your goals. Thank you, and I look forward to connecting to you soon.